How to get stinking rich during a recession. I know it's a weird concept to consider for most people, as they're either nervous about the immediate future or they're downright scared and they're just absolutely freezing. And that's a losing strategy right now because we're also experiencing record inflation. Just the basics of paying for food, energy, and gasoline are already a struggle for so many. And what they don't get is that money, it doesn't disappear during times like this. It just simply moves. And the question to ask is, how can you get yourself to where it is moving? And I'll answer that for you in just a minute. But understand, we had a big problem right here before we were dealing with a recession and inflation. Right here, this is a pie chart of today's 65-year-olds from the Department of Health and Human Services. And it shows at the age of 65, 54% are financially dependent, 36% are still working, 5% are deceased, and 4% are financially free, of which the government categorizes you as this, being financially free, if you're earning $40,000 a year from your investments. Not really free in probably 95% of the country. And this is the reality for 99% of the population because they follow the financial plan of work, sacrifice, and save. And if you're following that plan, you can expect the same result. But 1% does hit wealthy status, defined by the government as having a net worth of $5 million or more. And what 74% of them have in common is they either made or preserved their money in real estate. And more on that in just a minute too. But real estate, it is the vehicle that enables them to operate in a different way than the masses. Here, look at this. While the 99% work hard to save a mountain of money, with the goal of it reaching a height at some point to produce a stream of money to support them in retirement. The 1%, they flip the equation and focus on the goal first, creating the stream, and then they let the stream create their mountain. So the sequence here, it matters, as the above example is a 40-year plan. If it pans out at all, because the truth is, most people simply don't make enough to save enough for this plan to work. Now, the plan below, with the proper focus, guidance, and support, can be a 4-year plan or less. Income producing real estate is the vehicle that enables the average person to pull this off so quickly. Now, this is not get rich quick and easy. Let me clarify. Both of these approaches are hard work. But the question here to ask yourself is, how long do you want to work hard? Let's set this aside for a second though, and just look at real estate itself. The Federal Reserve just released this information about homeowners. An owner of a single piece of real estate is 40 times wealthier than a person that doesn't own any. Per the stats, if you don't incorporate real estate somewhere into your financial plan, you're not gonna make it. But what if you owned 2 properties, or 3, or 4? If you were able to acquire just 5 properties over the next 5 years, you'd be 2,000 times wealthier than the person that ignored this information and never purchased any. All right, so let's focus on the 2 big elephants in the room. Elephant number 1, recession. How will that impact the real estate market? Most people will be very surprised to learn that historically speaking, it doesn't impact it much at all. Of the last 4 recessions, real estate was negatively impacted in just one of those. Recessions and housing, they don't correlate. Recession does not equate to falling real estate prices. Most of the time, it's relatively flat, or it appreciates even. And let's look at elephant number 2, inflation. How does it impact the real estate market? Again, another surprise for many. Most of the time, the 2 are neck and neck, but housing has been significantly outpacing inflation for the last 10 years or so. Even when housing hit its most recent lows in 2013, it never dipped below the inflation rate. But right now, the 2 are happening at the same time. And we've got concerns about war, and we're watching the stock market get pummeled. How low could that go? And many are wondering, will the real estate market follow? What could all of this mean for real estate? Should you wait, or is it a good time to get started right now? Well, your decision will begin and end with looking at the big picture of supply and demand. Regardless of the product or service, when supply goes up, prices come down. And when demand goes up, prices go up, and vice versa. So let's start with looking at real estate supply. A healthy market has 6 months of inventory. And currently, we have less than 2 months in most markets. Here, look at this. Each of these lines represent housing inventory levels throughout the year. So the top 3 lines, they show somewhat normal markets in 2017 through 2019. The middle line, declining, shows the falling inventory levels of 2020 amid the pandemic. And then the bottom 2, 2021 and 2022, of where just a few months ago, we were at an all-time low. And as the economy struggles to recover from the pandemic, the seasonal inventory pattern is now resuming, but it's still very low. And is this necessarily a pandemic-induced problem like so many think? Here, this article from Forbes points to something else. The housing shortage is worse than ever and will take a decade of record construction to fix. You see, the US was on a record pace in their building, but everything stopped when the market crashed in 2007. Had building continued at the same pace, there would be 5.5 million more units of housing available right now. So to make up for the shortage that we're now experiencing, we'd have to build 2.1 million homes each year for a whole decade, more than it built each year during the housing boom of the mid-2000s. And that's not gonna happen because of this. You see, housing starts in the US sank 14.4% month over month in May of 2022, the most since April of 2020, and then sank another 1% in June due to the housing market facing so much pressure from rising inflation and mortgage rates. And then there's the elevated building material costs and labor and supply constraints weighing on consumers' affordability. They're not going to be building any more homes until they can turn a profit from doing so. So the supply shortage, it is what it is for the foreseeable future. And that is not a precondition for a crash or even a correction. You can't have a housing bubble when you're short on housing. Now, let's look at the other side of the seesaw, the demand. Simply put, we're talking about people. Sure, the population growth rate is falling. That's factual. But what's actual is the population is growing. But what's significant about this that you're not hearing in the media is the age demographic of the population. You see, the peak age at the moment is among the millennials at age 32, right here. And the age of the average first-time homebuyer is 34, right here. Which translates to over the next 24 months is that we're going to see more demand for housing than ever before in the history of the country. And then for decades after that, we have the biggest portion of the population that will need shelter too, Gen Z. But can they afford it? That's the big variable here, as mortgage rates are on the rise. Affordability is the big concern. Prices can't go up forever is what they say, right? Sure, the first-time home buyer and most of the middle class, they're getting squeezed out of the market. But is the market suffering because of it? The percentage of disposable income in relation to a household's mortgage cost, it's at an all-time low, of which means there are enough people that have got enough money to keep it going for a while. In fact, so far, there have been enough people in the market that have said, screw the interest rates. We'll just pay cash, as cash sales are up 1% since this time last year. And people, they're not stopping at just one property. Second home purchases are at an all-time high. Now, sales activity, that may be sliding. That's factual. But the median home price continues to rise. That's actual. You see, in June, home sales fell 5% from May, as prices set yet another record, an increase of 13.4% year over year. And by all expert accounts, prices will continue to appreciate, albeit at a slower rate, but still appreciate. You see this blue area where it appears at first glance that prices are predicted to retract? This is not the prices coming down. No, it's the rate of price growth that's slowing, but it's still growing. And with that, should you wait to get started? Now, I know at this point, it's becoming more and more obvious as to what you should do. But before you answer that, let's take a deeper look at this. Inflation. Jerome Powell made a major announcement back in August of 2020. But most of us underestimated the importance of this announcement, if we heard it at all. As we were all consumed with a pandemic, social injustice, and the most decisive election that we've ever experienced in our lifetime. Who had the time to think about Powell's inflation announcement when he said, the central bank will be more inclined to allow inflation to run higher than the standard 2% target before hiking interest rates? And here we are, mid-2022, at 9.1%. I think that's like almost double, right? And here's what that means in layman's terms. You see, if you had $100 in your bank account a year ago, it would have purchased $100 of goods and services. So fast forward a year later to today, according to the Consumer Price Index, that $100 will only purchase $90.90 of goods and services. You lost 9.1% of your purchasing power. But did you really lose just 9.1%? Is the Fed giving it to you straight? You see, most people don't know this, that food and energy prices are exempt from this calculation. So is the CPI a good index to use if it excludes the stuff that we actually buy in order to survive and function in society? I mean, if you look at a simple, everyday item that people consume, like the Subway sandwich index, it's not a real index, something I made up, but there's no such thing as the $5 footlong anymore. In October of 2021, the footlong sub was $7.29, a 45% increase. And just a few months later, January of 2022, $8.99, a 79% increase. So is 79% a bigger or a smaller number than 9.1% that the CPI says? You can no longer buy the entire footlong for $5, more like just 21% of it. Here, look at the Dollar Tree store. Nothing there for $1 anymore. Or let's look at another index, the gas index. Your $100 a year ago purchased $100 of gas. Today, just $50 of gas. So is inflation 9.1% or closer to 50% when it comes to the things that we spend our money on every day? And in September of 2020, one of the richest men in the world warned us about this in an article at MarketWatch.com. Ray Dalio said that the world is going to change in shocking ways in the next 5 years. And here we are just 2 years into it, and we are certainly experiencing shocking change. And he summed up the article with this. He said, worry as much about the value of your dollar as you worry about the value of your investments. Which really means, if your investments aren't producing at least a 9% return, you're getting poorer every day. Inflation, it's a hidden tax that's stealing the value of your money. But there's a bright side to this. Inflation is an equal opportunity value destroyer, as it also destroys the value of your debt. And so here's how this helps you as a real estate investor. Let's say that you borrowed $100,000 at 3% in 2021. Your monthly payment for the next 30 years is $421.60. On day one, you collect $1,000 of rent, and you collect that every month. And from that, you pay the mortgage payment. Now, assuming the national rent increase of 3.1% due to inflation, in 5 years, you're collecting $1,164 per month. But your mortgage payment stays the same. 5 years in the future, you're going to be paying today's debt with those inflated dollars of the future. You receive more dollars due to inflation, but the lender does not. The lender, they're stuck in the past. You see, just as inflation destroys the purchasing power of your dollar, it destroys the value of fixed rate debt too. You see, that same loan 5 years from now might be at 6%, but you have it for the term of the loan at 3%. And that debt now becomes as much of an asset as the property itself. So inflation causes rents to rise. That's a benefit to you. But what does a recession do to rents? Well, historically speaking, nothing. Nothing but up rents are going to go. 15% over the last year, in fact. So if you have owned an income property for more than 12 months, here's what this inflationary environment looks like for you. You experience the benefit of rising rents that would normally take 5 years to experience. You got it in just 1 year. And with no real signs of inflation slowing down anytime soon, this accelerated result can reasonably be expected for years to come. So if you don't own income property, you need to get some. The longer you wait, the further you're going to fall behind. Income producing real estate, it puts you on the right side of inflation. But is it just real estate? Is that our only option? I mean, what about gold? Isn't that a hedge against inflation too? Yes, so we thought. There is some time-honored wisdom that gold is a hedge against inflation. But why has gold dropped in value? Why is it no longer keeping up with inflation while real estate outpaces it? Again, while we were consumed with news about the pandemic, social injustice, and a crazy election, the media skipped right over this. Since 2005, J.P. Morgan had been manipulating the price of gold, and they got caught in 2020 and paid the largest commodity futures trading commission penalty ever. You see, gold, it's subject to manipulation. Housing is not. We've got more people than we've got houses, and the market is run on private individual transactions as opposed to institutional ones like gold. Real estate, it's all that there is. It's the average person's only option to survive in an economy like this, let alone thrive. Here's another dynamic that we're seeing that we don't see too often that suggests that this is a very opportune time to get started investing in real estate. And that's when the CPI is greater than the mortgage rates. So despite the recent rise in rates, they're still less than the CPI. And here's what that means to you. In 2005, here are the numbers. And because of how inflation destroys debt, the net interest rate for borrowing money was 1.7%. Not a bad interest rate, right? In 2022, the net interest rate for borrowing money is negative 3.3%. That's a little bit better. The economy is paying us 3.3% to borrow money. But it gets better. If we were to refer to our subway and gas index, the real net rate to borrow money is negative 44.2%. And we're wondering if this is a good time to get started? Inflation, it favors those that use other people's money to buy inflation-hedged income-producing assets. Inflation destroys those that don't. Here, look at this. Here's the terrible deal being dealt to the average person right now. The CPI sits at 9.1%. If you're just an employee, you received a 5.1% increase in your wages, something you'll certainly hear the current administration brag about around election time. But due to inflation, it actually results in a 4% loss in wages, something that they won't be sharing with you. If you were invested in the Dow Jones, you're down 7% in the last 12 months. But because of inflation, you're actually down 16.1%. Even worse, if you were invested in the NASDAQ, you're down 30.1%. If you thought you were safe investing in gold, you're down 15.1%. Everybody has gotten and is getting absolutely screwed, except those that invested in and are investing in real estate. They're up 7.8%. And if it was rental real estate that they invested in, they're up an additional 5.9% from the rents, equating to a combined inflation-adjusted return 13.7%. And I'm not even calculating amortization, the depreciation, and the tax deduction. So this is not the time to put your head in the sand and pray that this all goes away soon. Nor is this the time to isolate yourself and play defense. This is not the time to be saving money either. I mean, build up your reserve account, be responsible 6 months to a year of your household expenses, but saving beyond that results in a negative 8% return on your money. As the major savings accounts available to most of us, to all of us, they're all paying less than 1%. Here, look, right there on the far right, Capital One, they're bragging about their 0.4% return. Not 4%, 0.4%. By saving money, your wealth is getting crushed by 8% per year. You're losing money by saving it, which feels very counterintuitive to even say, but that's what's so. All right, so here's the action plan to win right now. Number 1, activate offensive mode. Defense is a losing strategy right now. 2, invest in yourself. Make yourself better. Boost your earning skills. Number 3, focus on income. You can't save your way to wealth, and nobody was ever set free by being debt-free alone. Number 4, use OPM, other people's money, to invest into inflation-hedged income-producing assets. And this may be unfortunate or fortunate for you, but real estate is the only asset for the average person that checks all the boxes. Now, I've been able to help countless people do this over the last 10 years or so, and I'm going to help countless more over the next decade. The opportunity is just too rich for me to not help those that want to be helped. And if you're having doubts about whether or not you can pull this off, I'm going to focus on just one person that I've been fortunate enough to work with over the last couple of years, Wayne Stoltzfus. You see, Wayne is from the Amish community, where technology isn't allowed. No cars, electronics, no powered machines. I mean, everything is done the old-fashioned way in the Amish community. Hand tools, horses, and buggies. And carrying debt, that's a big no-no. Wayne, though, he's a bit of a rebel in his community, and he decided that he wanted more out of life, and he wanted to become a real estate investor to get it. And when he came to me, he took a 3-day, $3,500 train ride across the country. And when he showed up to my office, he was carrying a box under his arm, and in the box was a computer, of which he had never used one before. So that's how it started with Wayne. And here's how it was going after just a few months of us working together. I got my first deal done today, $26,000 wholesale deal, and I've got 2 others under contract. Thank you for being patient with me. The future is looking really bright. Now, I rarely hear from Wayne anymore because he doesn't need my help anymore. That's the goal, to make him independent. I mean, the last time I heard from him, he was receiving enough passive income from his rentals that he no longer needs to work. And this all happened in less than 24 months for him. What 99% of the population is unable to do in 40 years of toiling away at their job. Anyone can do this. It's just that most people won't do it. And there lies your opportunity. So the original question that I asked, is this a good time to get started in real estate? Well, if you are paying attention, I'm going to answer the question with a question. Can you afford not to? And that leaves us with really just one final question. Do you want to go slow or do you want to go fast? I mean, you can take your time and piece everything together and, kind of work by trial and error and go slow. Nothing wrong with that. It's exactly how I did it. Or you can plug into a proven system with resources and support and go fast. I mean, if I had to do it all over again, I'd choose fast. But this is your decision. So what will it be? Slow or fast? If you want to go fast with Epic, reach out and follow in the footsteps of the thousands that made the same decision, the right decision for them. So I'm really glad that you were here. I appreciate your time, and I'll see you soon. Take care.